Our mission today is to, well, unpack a massive stack of high-level financial research so we can figure out exactly what is happening in this global financial ecosystem right now.
And we have a lot of ground to cover.
We really do. We're looking at Q4 2025 earnings presentations, Morgan Stanley's 2026 economic outlook, and a really comprehensive equity research report.
Yeah.
And to anchor all this macro theory in reality, we're focusing on two completely different financial behemoths operating today.
Right. So we have Western Union, which is the legacy money transfer giant, fighting in the trenches of physical cash.
Yep.
And then Moody's Corporation, the risk analytics powerhouse, it's essentially selling the maps to the global credit markets.
The contrast between these two tells you, it tells you everything you need to know about where the global economy is heading in 2026.
Definitely. If you want to understand the future of finance, you really have to look at the friction of moving physical money versus the frictionless scale of moving financial data.
Okay, let's unpack this.
Yeah.
Because before we pull apart Western Union and Moody's, we need to actually understand the ground they're standing on.
Right.
And Morgan Stanley's 2026 outlook paints a pretty fascinating picture of the current state of the global economy.
It does. The baseline for 2026 is what Morgan Stanley is calling a moderating resilience.
Moderating resilience, okay.
Yeah, so they see global economic growth dialing back slightly to 3% for 2025 and then ticking up to like 3.2% in 2026.
Got it.
And the U.S. is really leading that charge. It's showing a subdued but very stable 2.4% growth recently, though forecasts do see that cooling to 1.8% in 2026 before it eventually rebounds to 2.0% in 2027.
And that U.S. resilience is crucial, right? Because it's happening alongside this cooling inflation we're finally seeing.
Exactly.
The last couple of years, inflation has been like the monster under the bed for the markets. And now that it's receding, central banks actually have some breathing room.
Yeah, the expectation laid out in the reports is 1 to 2 rate cuts from the Fed in 2026.
Which is huge.
It is. Those rate cuts act as a sort of release valve for corporate borrowing. However, U.S. consumer spending and these massive capital expenditures, specifically around artificial intelligence, those are the primary engines keeping the economy moving forward right now. But, it's not a perfectly smooth ride.
Well,
We are seeing significant policy shifts that are creating heavy turbulence.
which brings up a really critical variable from the equity research report regarding recent tariff implementations and shifting immigration policies.
Yes, that's a big one.
And these structural changes are having a direct, measurable impact on labor markets and, well, consumer spending patterns.
They are.
And look, these are obviously heavily debated political topics right now. So just to be entirely clear with you, the listener, our goal today isn't to weigh in on the politics of these policies from either side of the aisle.
No, not at all.
We are strictly looking at the mathematical reality of how these shifts impact corporate balance sheets.
Right. Mathematically speaking, shifting immigration policies directly affect the core customer base for cross-border remittances.
Right.
While tariffs obviously alter the flow of international trade capital, and looking at the numbers, the financial sector is experiencing a massive bifurcation as a result of all this.
Bifurcation meaning like a total split in the industry.
Exactly. On one side, legacy operators are undergoing incredibly painful structural transformations just to stay afloat.
Yeah.
And on the other side, you have high-margin intelligence and data firms that are just riding an unprecedented wave of AI investment and private credit.
And that structural pain leads us perfectly to our first stock, which is the Western Union Company, ticker symbol WU.
Yep.
Let's look at the specific country and sector economy they operate in. The global cross-border payment market is booming right now. The Airwallex report projects transaction volumes will hit a staggering $156 trillion this year.
It's an almost unfathomably large pie, honestly.
Yeah, it really is.
But the regulations dictating how you can slice that pie are shifting completely beneath Western Union's feet. The major catalyst here is the newly enacted One Big Beautiful Bill Act.
Right, which went into effect on January 1st, 2026.
Exactly. And this legislation imposes a 1% excise tax specifically on cash-funded remittances.
And again, staying completely neutral on the politics of that bill, we have to look at what a 1% tax actually does to the unit economics of a money transfer operator.
It's devastating.
Right, because in a business where your profit margin per transaction is often measured in literal pennies, skimming a full 1% off the top of the gross transfer amount, it completely shatters the legacy model.
It forces a structural pivot. Western Union's defining characteristic for decades has been its physical agent network.
Yeah.
You walk into a physical storefront like a bodega, a post office, or a dedicated agent, you hand over physical cash, and someone picks it up on the other side of the world.
Right.
They essentially build an analog network of global toll booths.
All right.
But that physical, cash-heavy model is exactly what the new excise tax targets.
So they are desperately trying to transition their product suite away from those legacy cash wires toward digital solutions.
Right. Primarily their digital Vigo money wallet.
Yeah, and when we look at their financial analysis, their standard, universally recognized JAP revenues for 2025 stat at $4.05 billion.
Which sounds good on paper.
It does, but that top-line number hides the immense friction of their current reality. Because trying to pivot from physical storefronts to a digital wallet means they suddenly have to acquire users digitally.
Yeah.
They're competing on, like, app store optimization and user interface design against nimble Silicon Valley startups. It's like trying to turn a massive physical freight train into a high-speed fiber optic cable while it's moving.
It's a great analogy. That physical to digital migration is incredibly expensive. You have to maintain the massive fixed costs of your legacy cash transfer network because, well, that's what currently pays the bills.
Right, you can't just shut it off.
Exactly. While simultaneously pouring huge amounts of capital into developing and marketing the Vigo money wallet.
So let's talk about the valuation and the investment thesis here, because this is where it gets really highly debated among analysts.
It really does.
The stock is currently trading around $8.50 per share. Historically speaking, that is dirt cheap for them. The equity research report labels it a speculative buy, and the primary investment thesis is built entirely for income-seeking investors.
Yep.
Why? Because Western Union boasts a massive 10.8% dividend yield.
And a yield that high demands serious scrutiny.
Oh, absolutely.
You are buying into the medium-term volatility of a business in total transition, and you are also absorbing the direct negative margin impact of that new 1% excise tax.
So I have to push back on the analysts here a bit, and I really want to hear your take for our listener. Is a 10.8% yield a treasure chest or a trapdoor?
That is the big question.
Because usually, when a yield spikes that high, it means the market has priced in an imminent dividend cut, where the underlying stock price is cratering so fast that the yield is just an illusion.
It is the ultimate value investor's dilemma, honestly.
Yeah.
The analysts advocating for the stock argue that the 10.8% yield acts as a total return cushion. Yes, the legacy business model is under severe threat. But if you have the stomach for the volatility, that dividend pays you generously to wait while management executes this digital turnaround.
Right.
Make no mistake, though, the risks are substantial. If cash remittance volumes drop faster than digital wallet adoption grows, that dividend will eventually be slashed.
And if we compare them with their rivals and look at the broader sector analysis, the Airwallex report breaks this down beautifully. The 2026 remittance market is completely split.
It is. On one end of the spectrum, you have simple, zero-fee remittance apps. Think of agile, cloud-native competitors like Wise and Remitly.
Right.
On the other end, you have comprehensive financial operating systems targeting huge corporate flows. Western Union is stuck in the messy middle, fighting to prove that its legacy network still holds value against digital competitors who, frankly, don't have to pay for thousands of physical storefronts.
Right, they don't have that overhead. And the latest developments for Western Union are entirely focused on this survival pivot. The major news items are their push to successfully transition users to the Vigo money wallet and the imminent closure of their deal with Intermex, which is supposed to consolidate their market share in Latin America.
Execution on those two fronts is everything. When we look at the prediction discussion, analysts see a 10 to 15% price upside by year-end.
Okay.
However, they make it very clear that this prediction is entirely contingent on the Vigo money wallet transition succeeding and the Intermex deal crossing the finish line.
Right.
If they stumble on either of those, that 10.8% yield won't protect the stock price from falling even further.
It's a really high-stakes balancing act for a legacy giant.
It really is.
Now, before we pivot to our second company, which operates in a completely different universe of profit margins and predictability, I want to take a quick second to speak directly to you.
Yeah.
If you want us to keep distilling these massive 50-page equity reports into actionable insights that save you hours of reading and research, do us a huge favor and hit that subscribe button, leave a like, or drop a comment on our YouTube channel.
It really helps.
It signals the algorithm and helps us keep these deep dives coming.
All right, let's make that transition from the physical to the intellectual.
Yes, let's do it.
Because if Western Union represents the gritty transactional flow of cash across borders in a low-margin environment, Our next company represents the intellectual infrastructure governing the capital that builds the modern world.
Exactly. We're talking about Moody's Corporation, ticker symbol MCO.
Yep.
Going back to our earlier thought, if Western Union is the toll booth, Moody's is the GPS map. They are the risk assessment engine of global credit.
And the country and sector economy backdrop for Moody's is nothing short of exceptional right now. In 2025, there was a record $6.6 trillion in rated debt issuance globally.
Wow. That is a staggering amount of capital moving through the system.
It is, and it is being driven by massive structural shifts in the global economy. We are seeing unprecedented capital expenditures for AI-driven data centers, sweeping global infrastructure projects, and a huge wave of sovereign debt refinancing. Every time a corporation or a government wants to issue debt to fund these massive projects, they need a trusted entity to grade that debt.
Moody's is essentially the referee of global credit.
Exactly.
If you want to borrow billions, you need them to score your creditworthiness. And the company characteristics are fascinating, starting with who actually owns them.
Oh, yeah.
Berkshire Hathaway, Warren Buffett's conglomerate, is their largest institutional holder, sitting on a massive 13.86% stake.
Which is wild.
It is. And having the world's most famous value investor as your biggest backer provides an incredible psychological anchor for the market.
The numbers totally validate that confidence, too. When we look at their financial analysis, Moody's total 2025 revenue hit $7.7 billion, which is a 9% increase over the previous year.
Let's break down their products and revenue shares, because the business is split into two distinct, high-performing segments. First, you have Moody's Ratings, formerly known as MIS. This is the traditional referee business, evaluating the debt we just talked about. That segment alone brought in $4.1 billion, and the operating margin on that revenue is 63.6%.
Wait, a 63.6% margin is just staggering.
It's insane.
It highlights the incredible operating leverage of a business where your primary cost is intellectual capital. You aren't building factories or managing physical inventory,
Right.
You are paying brilliant analysts to evaluate risk and then selling that evaluation at an enormous premium.
And then you have the second segment, which is Moody's Analytics, or MA. This division brought in $3.6 billion with a 33.1% operating margin.
Yeah.
But here is a really critical characteristic. 97% of MA revenue is recurring.
Wow. Recurring revenue is the absolute holy grail for any data or software company.
Yep.
It means you don't have to start from zero every January 1st, right? Your customers are locked into subscriptions, and they are dominating this space with key products.
Let's talk about those products.
Yeah, so you have Credit Lens, their AI-enabled digital lending suite, which is their fastest-growing banking product, up nearly 20% annually.
Hey.
You have Orbis, which is their massive global company database, and Agentix, their new AI workflow solution that literally automates complex credit memos for banks, which saves analysts thousands of hours.
And the overall financials really reflect this dominance. Their adjusted earnings per share, or EPS, hit $14.94, which is up 20%. And their return on equity, the ROE, is a jaw-dropping 66.01%.
We really need to pause on that metric because it is the core of their valuation.
Yeah, let's break that down.
Return on equity is essentially a measure of how efficiently a company uses shareholder money to generate profit. So for every dollar of equity capital, Moody's is generating 66 cents of profit in a single year.
Which is just unheard of.
It is.
Yeah.
That kind of efficiency proves they possess a massive, almost impenetrable competitive moat.
But, that moat comes with a pretty hefty price tag.
Huh.
Let's look at the valuation and investment thesis. The stock is currently trading around $439 to $443. The trailing PE ratio, meaning you are paying roughly $32 for every $1 of profit they made over the last 12 months, is sitting at 32.13x.
Right.
Independent analysts literally give it an ultra-expensive value score of 12. So here's where I need you to translate this for our listener.
Sure.
How can a stock with an ultra-expensive value score and a 32x PE ratio possibly be rated a strong buy in this report?
It comes back to the classic Warren Buffett philosophy, honestly. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Okay, that makes sense.
The premium valuation is justified by two things. First, that 66% return on equity we just talked about. They compound capital at an extraordinary rate.
Yep.
Second, that 97% recurring revenue in the analytics division. When nearly half of your $7.7 billion business is built on locked-in, high-margin subscriptions, it acts as a massive shock absorber against economic downturns.
Right.
You are paying a premium because you are buying into a near monopoly that is highly resilient to market shocks.
But they aren't completely immune to risk. What are the specific threats to this thesis?
Well, the biggest near-term risk outlined in the research is an AI equity price correction.
Oh, like a bubble bursting.
Exactly. Moody's ratings division is currently feasting on the debt being issued to build massive AI data centers. If the hype around AI cools off, those capital expenditures halt, and corporate debt issuance could drop sharply.
That makes sense.
Additionally, geopolitical conflicts, particularly in the Middle East, could cause sudden energy shortages. That would impair the credit quality of lower-rated issuers and cause default rates to spike much faster than Moody's models currently predict.
Wow, okay. And I was looking at their comparison with rivals, and you mentioned a near monopoly earlier. Technically, it's an oligopoly, right? The big three.
Yeah.
S&P Global, Moody's, and Fitch.
Correct. Moody's and S&P Global each control about 40% of the global ratings market, while Fitch holds roughly 15%.
Yeah.
What makes this oligopoly unique is that it is legally entrenched. Global financial regulations often mandate that investment-grade entities must use at least two of these big three rating agencies.
So they literally have a captive, legally mandated customer
Okay.
base. I noticed an interesting discrepancy in the sector analysis, though. S&P Global actually has a much larger market cap, $127.1 billion compared to Moody's $78.5 billion.
Right.
Logically, I assumed the bigger market cap meant S&P was the higher quality sector leader, but the metrics completely contradict that assumption.
Yeah, it's deceptive. S&P is larger because they have a more sprawling portfolio, including major index products like the S&P 500 itself.
Oh, right.
But when you look at sheer operational quality, Moody's is the superior pure-play data business. Moody's net profit margin is higher, 31.9% compared to S&P's 29.2%.
Nope.
And when you look at independent grading systems that measure financial health and future expectations, Moody's crushes S&P. In AAI quality scores, Moody's scores a near-perfect 99 against S&P's 62.
That's a huge gap.
And in earnings estimate revisions, which tracks how often Wall Street analysts are forced to upgrade their profit expectations, Moody's leads 66 to 42.
Looking at the latest developments in news, MCO stock is actually down roughly 13% in early 2026. It fell from a high of $546 down to this $432 to $443 range.
The reports indicate that this drop is driven by broader market volatility and rising treasury yields, not fundamental weakness in Moody's actual business.
Right, the macro environment.
Yeah, and because of their incredibly high-quality scores, many analysts view this 13% pullback as a prime buying opportunity. Management is also actively optimizing their portfolio. They just sold off their learning solutions and regulatory reporting businesses so they can direct all their capital and focus entirely into high-growth AI applications.
Speaking of their data applications, there was a fascinating specific anecdote in the earnings presentation regarding their Orbis database.
Oh, the Interpol story.
Yes. Interpol, the international police organization, is actively using Moody's Orbis data to track illicit finance networks. And that specific data integration recently resulted in 83 arrests across 6 different countries.
It perfectly illustrates why their intellectual property is so valuable. You cannot just scrape the ownership structure of a global shell corporation off a Google search.
Right, you need the real data.
It requires highly curated, verifiable, domain-specific intelligence. Interpol pays for Orbis because it is the ground truth.
So when we move to the prediction discussion, what does this all mean for the stock price going forward? Analysts have set a fair value target price between $550 and $595.
That target represents significant upside, and it is firmly backed by their strong 2026 guidance. Management is projecting high single-digit revenue growth, EPS between $16.40 and $17, and a massive $2.8 to $3.0 billion in free cash flow.
Which is incredible.
And crucially, they plan to deploy $2 billion of that cash directly into share repurchases, which continuously boosts shareholder value by reducing the number of outstanding shares.
We have covered incredible ground today. We look at a legacy company in Western Union fighting for survival by trying to migrate physical cash users to a digital wallet in a shifting regulatory landscape.
Yep.
And we looked at a modern data monopoly in Moody's, capitalizing on the AI boom and acting as the intellectual referee for global capital.
The contrast between the two shows the sheer breadth of the financial sector right now. But if we connect all this back to the macro picture, there is a provocative undercurrent here regarding AI that wasn't really the main focus of our sources, but feels incredibly relevant to where the economy is going.
Oh, I like this. What is the thought to leave our listener with?
Well, we are rapidly entering an era where generative AI can synthesize and, frankly, hallucinate infinite amounts of text, code, and media.
Right.
Information itself is becoming cheap and infinitely abundant. But because of that, truth is becoming scarce. In a world where AI can write the internet, verifiable, permission, domain-specific data, like knowing exactly who actually owns a complex string of shell corporations in Cyprus, that might become the single most valuable commodity on Earth.
That's a profound point.
Companies that own the proprietary ground truth data aren't just selling software anymore, they are positioning themselves as the ultimate arbiters of reality.
Wow. Who guards the truth when AI writes the internet? That is a heavy but incredibly important concept to mull over.
It really is.
As a quick reminder before we sign off, we have to state that all investments carry inherent risk. The stock market is volatile, and you should always do your own thorough research or consult a professional before making any financial decisions.
The economic landscape is full of, well, diagnostic muddy waters, and careful navigation is essential.
Whether you are looking at a company trying to rebuild its engine mid-stride, or a company selling the high-tech maps to navigate the storm, the global financial ecosystem is shifting faster than ever. Thank you so much for joining us to unpack it all. We'll see you in the next deep dive.